Well, good morning, everybody. We all set back there, Grace?
Thumbs up, she said.
Can't see you. Have to talk. Thank you. So, good morning, everybody. Welcome to the November 17th meeting of the Merrimack, New Hampshire Trustees of Trust Funds. As usual, we'll start with introductions. I'm Chris Christensen. To my right is,
Bill Wilkes, trustee.
on my left,
Liz Petrides, trustee.
and
Adam Britton, Town Finance Director.
joining us we have also
Eric Jusom from Cambridge Trust.
Lindsay Donovan from Cambridge Trust.
Toronto from Cambridge Trust.
very good. Thank you. And the first order of business, let me just write. Oops. We okay?
Sorry.
It's okay. It's town property. We know how to get at you. Okay, first order of business is approval of the minutes of September 22nd. We have a motion.
A motion to approve the minutes of September 22nd is written.
Second.
Any discussion? Seeing none, all in favor signify by saying aye.
Aye.
Aye. Motion carries 3-0-0. Oh, first order of business is a review of our portfolio and other activity with Cambridge Trust. Who's first?
I will start off.
Okay.
It's not projecting up on the screen. Should. Just want to make sure.
Everybody in town can see it when they watch this during the Celtics game.
All right, should it be on our monitors as well? Well, the monitor's on, I'm getting a placeholder, but no presentation.
It's fine.
All right, well, we'll just press on then.
Okay.
Eric, you've got the floor.
All right, thank you. I'm going to talk about what's going on in the economy and the markets, and we'll dive into the portfolio thereafter and some of the changes that we have made. Just starting with the economy, as everyone knows, the Fed has raised interest rates 550 basis points over the last 18 months, the steepest ramp up in history. And what we're starting to see now is all these interest rate hikes of starting to act with a lag. And the intended goal of the Fed was to reduce inflation, and it has slowed. Latest print was 3.7%, again, above the Fed's 2% target. Fed has indicated, they're on pause right now, but if inflation were to trend higher, additional rate hikes may come at some point in 2024. But I think for the most part, the consumer continues to spend. Consumer spending has been strong. GDP for the third quarter was at 4.9%. So it's been a pretty, if you consider you've had 550 basis point increase in interest rates and the economy is still growing, still has, it's expanding, the expansion has slowed, but we're still growing at a reasonable rate. And at the same time, inflation has ebbed. So the Fed is getting close to their dual mandate. Remember, the unemployment rate has trended a little bit higher, but we are pretty much, below 4% on unemployment. There's still more job openings than there are workers. So the Fed's job is not quite done, but it looks like that pause will continue. And if you look at the ever optimistic Fed future curve market, they're actually anticipating 3 rate cuts in 2024. So if you go back, flash forward to 2022, the Fed futures market is already anticipating rate cuts in 23. So, if you look at the inversion of the yield curve, it has bull bear steepened in the last 6-7 weeks. So meaning short rates moved higher than long rates. I'm sorry, long rates moved higher than short rates. So we've had the highest yields right now in about 20 years. 10-year Treasury did get close to, it did touch 5% several weeks ago. It has since come down to about 4.4, 4.5%. So a lot of that ramp up in the long end of the curve was due to the amount of Treasury issuance, the downgrade by Fitch to AA+, And plus, inflation remaining higher, but, still trending lower at the same time. The market now pricing in the higher likelihood of the Fed on pause versus the rate cuts that they were expecting, or because everybody was expecting a recession at some point in 2023. Goldman Sachs has since reduced their recession forecast to a probability of about 15% for 2024. So, it seems like, we're Fed may be for the first time ever to actually orchestrate a soft landing, thread that needle perfectly, keep the economy afloat while reducing inflation. So on that backdrop, coming into 2023, remember 2022, the markets were relatively strong, especially for your portfolios, which have more of a dividend flavor to them, so more of a value focus to try to achieve the income to meet the expenditures. 2023 has been an exact flip of that. So growth stocks are vastly outperforming value stocks. If you look at, the Russell 1000 index, that is up year to date of almost 25% versus the Russell 1000 value is only up about 2%. So pretty big differentiation. And within that growth sector, if you focus on the S&P 500, most of those returns are coming from 7 to 10 stocks. So it's not been as robust as you would think. There's this term, the Magnificent Seven. If you have any exposure to Meta or Facebook, Nvidia, Netflix, Amazon, Google, your returns have been very strong this year. Because of the focus of the portfolio for dividend-paying stocks, the returns are not as good as the S&P 500, but against the benchmark, the the Nasdaq U.S. Broad Dividend Achievers Index, it's very close to where it is. There's some sector weights. If you look at within the S&P 500, there's 5 negative sectors that tend to be more defensive and more dividend focused, and that's where we have, especially in energy and overweight. And again, companies are still strong. If you look at third quarter earnings, 90% beat on earnings. So you're still seeing, as I was mentioning earlier, the economy continues to grow. Corporate earnings continue to do very well in this environment. So overall, the biggest thing has been, the change in interest rates, especially in the long end of the curve where we saw interest rates ratchet up quite substantially. And within the portfolio, we've actually tried to take advantage of the higher interest rates. Just last week, we purchased 15-year pass-through mortgages for both the income and principal portfolio. Yields very close to 6%. Again, an average life or duration about 4 years based on speed factors. So we think that was a very good opportunity. Earlier in the third quarter, we did add a little bit more to corporates as well as some agencies with yields north of 5%. So if you want to turn ahead one slide here, just to focus on the yield of the overall portfolios, as you can see, from the last time we met in April through 10/31, yields are up substantially across all the portfolios. Especially look at scholarship yield went from 3.5 to 3.8. Common principal went from 3.87 to 3.92. Common income went from 3.91 to 3.86. A little bit of a differentiation there is we've actually added a little bit more to equities as that portfolio can actually pay out a little bit more of capital gains versus the principal portfolio. So I think if you turn to the next slide, year to date, slightly underperforming the Nasdaq U.S. Broad Dividend Achievers Index. Return about 22 basis points. Income and principal down about 44 to 80 basis points. Bond returns have outperformed as we've been overweight high credit quality as well as a little bit underweight duration. Through Q3, we've actually started to get a little bit more of an overweight to duration just to try to lock in the highest yields we've seen in about 20 years. Turnover continues to be low. We did, and as I mentioned earlier, in the income portfolio, we did add a couple additional stocks. We added Analog Devices to the portfolio, as well as Donaldson and Rollins Corp, just trying to get a little more growth in the portfolio. And in the other accounts, the capital reserve portfolio.
Excuse me, what's the yield on Analog Devices?
It's close to 2%. So it's a little bit lower than Texas Instruments.
Do you know they're very similar?
They're very similar. It's just Texas
and they've
Instruments.
inverted.
Yeah.
Texas Instruments was always higher, had a higher stock price than Analog, and Analog trailed them, and now they've kind of inverted.
Yep.
And I'm not sure why.
Well, I think
because they make a lot of similar type products.
They make similar products. The reason why we sold Texas Instruments is they have a 4-year capital improvement project in place that's going to impact free cash flow. So we like to get back into the stock, but based on valuations and potential for gross margin compression, we felt it was worthwhile to move into analog. So very similar. I think analog has a little bit more of the higher end analog semis or chips compared to what Texas Instruments will now be moving into. So we think at some point we may own both, but we felt for the near term, at least for the next couple of years, we thought analog would be a better play.
They don't really, Texas Instruments, they're just neck and neck
Yeah.
on technology.
Okay.
So, in Analog acquired several linear companies that, in Texas Instruments, had also done the same thing, so they kind of consolidated the industry.
Yep.
So, anyways,
Bill used to be part of that industry.
I can tell.
well, I worked for a company that was bought by Texas Instruments.
Okay.
Yeah. So
But they're still great companies. It's just
they're both good companies. They're
I
both
think at some point
really good companies.
we'll probably go back into Texas Instruments once it gets a little cheaper.
Yeah, it got down to 140, and now it's what, 150 again?
Yep. Yep,
As
exactly.
long as we're on a little bit of a pause, let me go back a minute. You talked about buying mortgages,
Yes.
and those are in the common funds?
Common principal and common income. Yes.
Okay.
Yeah. We did not.
I was just trying to translate that into changes that are occurring in the CD and government security markets, which I think we'll get to in a minute.
Yeah, those are more for the capital reserve portfolios where we buy most,
Okay.
CDs as
We'll
well.
move along.
Yeah. Okay.
Thank you.
I was just gonna interject or ask one, what about the utility companies? They've gotten killed. And I know it's probably driven by bond interest rates.
Correct. Yeah. That's
So, I mean, depending on what your view is on interest rates, aren't utilities pretty cheap?
Utilities are cheap. We still have Atmos as well as Wisconsin Energy in the portfolios. We've held them. We have a slight overweight versus the benchmark to utilities. We think they're cheap. It just, it's more of a bond surrogate, right? So you have higher yields right now in bonds, but
Next era's about half of what it was.
correct. Yeah, they had about a 30% pullback. It's come back a little bit off of that from that downturn. But again, both Atmos and Wisconsin Energy have higher dividend yields. I'll look at NextEra where that dividend yield is now, but at the time, both of those companies that we own had a higher dividend yield than NextEra.
Next era used to be, 2 years ago, was just going crazy, buying up stuff all over, and was almost a growth stock for a while.
Yeah.
But I was looking at it, and Duke is paying 4.5% yield. However, I can't figure this out. The payout ratio is 269%. I don't know how they can afford to do that.
Don't think that's a good business model, but
Yeah.
Well, they obviously got a lot of money in their pocket.
somewhere, something's going on there. So again, the capital reserve portfolios, we're typically laddering out 1 to 3 years, and those returns, because of the shorter maturities, are actually doing very well in an overall total return basis. We're going to turn to the next slide.
3.3% next era.
3.3. Okay. So I mentioned earlier, just want to look at some of the returns. These are as of 9/30. If you look at like the S&P 500 compared to the Russell value and more value favored indices, there's a big gap. So as I was mentioning earlier, growth stocks by far lead outperforming value stocks. And again, the portfolio has more of a value focus to try to achieve the high current dividend yields. And with that, going to turn to the next slide. If we can go through a couple of these slides here, I've talked about them earlier, but just to reiterate. So this is as of November 13th, post-Fed, and especially post-CPI. You can see, if you look on the bottom chart, where you see the bigger bar chart there, the bigger boxes. If you look out towards, January of 2025, so a little over a year and a half, a little over a year from now, you can see the market's pricing in about 3 rate cuts, bringing the overall Fed fund rate down to about 4.5%. So again, it could be overly optimistic, but if you look at historically when the Fed has raised interest rates, it has always, especially with the inversion of the yield curve, has always led to some sort of an economic slowdown. We don't see a really hard landing or hard recession. We think more of a softer or bumpier type landing versus a full-blown recession. Obviously, there's a lot of tension in the world right now with what's going on in the Middle East as well with Russia, Ukraine. If those were to escalate, that would change the outlook. But based on what we're seeing right now and what our expectations are, we're probably gonna have more of a softer versus a harder landing. The less inverted yield curve. This looks at the yield differential between the 2 and the 10-year Treasury. At the peak, that differential was about 120 basis points. Now it moderated to about 15 basis points. And just with, the higher backup in yields in the last couple of weeks, that has restabilized to about a 40 basis point inversion. As I was mentioning earlier, income is back, yields are attractive. We're taking this opportunity right now to try to lock in some longer term yields. Most corporate bonds we're buying have 5-year maturities. Yields are well north of 5%. 5-year agencies are 5.5% range, as I mentioned. We've done 2 tranches of buying mortgage-backed securities, and the second tranche had, yields close to 6%, which we think is a very good opportunity.
What about something like PFF? That's paying like 7%.
I'm not familiar with PFF.
Preferred. It's a preferred.
The preferred
index
ETF?
fund, yeah. ETF.
We do have a Nuveen preferred mutual fund in the portfolio, which has a high yield as well. But it's more of an actively managed mutual fund versus the ETF. Again, turning to the next slide here. As I mentioned earlier, valuations getting a little expensive. We look at the market as a whole, but if you factor out those top 10 stocks, valuation is actually relatively reasonable. So it's not excessive. It's really those 7 to 10 mega cap stocks that are really putting a lot of that weight on the index as far as an overvaluation goes. And I think there may be 1 or 2 more slides here. So I was showing you earlier, year to date. So look at the top 10 performers as of 9/30. You can see really leading the charge as far as return goes. And the remaining, 490 stocks are actually underperforming the broader market. As I mentioned earlier, you have 5 sectors that actually have negative returns this year. Those being energy, utilities, consumer staples, healthcare, and REITs. In your portfolio is overweight both utilities and energy, which have had a substantial pullbacks compared to where they were in 2022. And with that, we can go through the portfolios, one by one here, just looking at the overall asset allocation returns. I'll leave it up to, how you guys want us to
So
proceed.
based on the fact that we have utilities and other, banks or whatever that have underperformed, you're not proposing to get rid of those, are you?
No, we're not. We talked at our last meeting of possibly reducing finance, and we did not. Valuations just got really compellingly cheap. Obviously, there's still a lot of stress, especially in the regional banks. But J.P. Morgan's actually has a positive return over the last 12 months. So we still own J.P. Morgan in the portfolio. We own PNC Bank, which is one of the larger regional banks, making a big inroads into wealth management for non-interest income growth. And also, we own Bank of America. So we still like the banking sector. Obviously, it's underperformed this year, especially what happened in the first quarter this year with Signature Valley Bank, Signature Bank failing, Silicon Valley Bank and First Republic both failing. So, we think the sector is cheap. We still, we're a little underrated. We're almost neutral to the sector, but we still like it for long term. Same with utilities. They are very cyclical. This is a time we may look to add based on weakness, but overall, we're not looking to trim those positions.
So we're part of the strategy is just sector balance.
Not a rebalance, but it's more of, where we're finding the opportunities right now for yield, especially for the principal portfolio. With the income portfolio, we've added a little bit more to try to get some of the growthier, not growth names like NVIDIA and Google into the portfolio, but buying like a Donaldson Corp or Rollins Corp, and especially Analog Devices, trying to get some of those into the portfolio at reasonable valuations. The market, some of those, the mega cap tech stocks have really have gotten expensive. And NVIDIA is a very, it's a great company, but, the stock returns this year are through the roof.
That has gone from like 110 to 350
Yeah,
in
exactly.
a year, less than a year.
Yeah, exactly.
So
Yeah.
Broadcom's gone from 450 to 900 something.
We own Broadcom. So, we do have, it's not that we don't have exposures, we've participated.
is it the Lemming syndrome?
What's that?
Is it the Lemming syndrome?
I don't know what the limiting syndrome.
Everybody following the crowd? And
Oh, yeah.
then there'll be
No,
a big
we're not.
bust?
No, we're not. It's TINA, right? There is no alternative. We're finding other alternatives versus, following the herd mass. If you want, we can go. I'll have Lindsay run through some of the portfolios here, especially the capital reserves, just to give you an idea of the cash balances and how those are structured.
Yeah, in a more general sense, Lindsay, I'm curious about the attempt to get some more lock in some long-term returns versus our existing ladder maturities, how that's gonna, how much lag we're gonna have because of existing maturities.
Sure. So the current high point of the yield curve is still the 6-month bill. It's around 5.5%. As of yesterday, it was around 5.45, so it's a little bit less, but it's been hovering around that 5.5 for quite some time now. As you go out along the yield curve, I think Eric showed it in a chart earlier, we are still inverted. So the 2-10 spread is negative, and that actually extends out through the 6-month. So going from 6 months to 2 years, you are losing some yield by going further out into the future. That being said, it does still make sense to, continue to extend the ladder, to roll, to lock in these rates, because eventually the Fed will have to cut. And when that happens, the Treasury curve will reprice, as will CD. So it's a bit of a balancing act with trying to find the most advantageous yields and lock in rates throughout the ladder of the portfolio. But with the money market so high, it isn't adverse to keep a little bit extra in cash at the moment either.
Yeah, our money market right now is paying 5.2%. You compare that to like a 2-year treasury, and it's a higher yield, but at the same time, it's that counterbalance of, we want to lock in, if especially if you look at the Fed's long run projection of Fed funds rate. Again, in Fed speak, they don't tell you how long the long run is, but they have 2.5% as their target. So at some point, as Lindsay was mentioning, rates will start to come down. So you can never get that actual perfect timing in place. But I think we've been extending durations a little bit, especially in some of the portfolios where we can try to extend durations and lock in these higher yields.
I was just thinking more in terms of as we do the normal rollovers, because we've got shorter or lower returns right now on some of the lags, that will eventually catch up. And I was just wondering when you think, if that's going to be 2 years out, 3 years out.
Sure. So within the water and within the school district portfolios, they're pretty short term. I think most of the lower coupons are within a year and a half of maturity. Within the municipal portfolio, it does have a longer final maturity date for that ladder, so extending out more towards that 3-year point. That being said, as we've been buying newer securities and filling it in on the longer end, those shorter, lower term coupons, those lower yielding coupons are rolling off. So the portfolios are marked to market. So within the yields that you're seeing, yield to maturity, yield to worst, all of those metrics, they are being priced to market. So you're seeing that impact of higher rates reflected within lower mark to market prices. So all that means is if we were to go and sell those CDs in the market today, they would be at a lower cost compared to where we purchased them. That's not the intention. We would hold them until maturity since it is a capital reserves portfolio. But it does get reflected on a monthly and on a daily basis based on the market movements. So I do believe, adding those longer term rates that are at these higher current levels, Eric showed that slide a little bit earlier. We are at the highest levels that we've seen in quite some time. We came off of that very low zero interest rate lower bound that existed for many years. So having these higher starting points is beneficial to the portfolio, and will continue to generate that annual income for you for the life of these CDs, as opposed to the money market, which has a high current rate today that it's paying out, but that is a much shorter time frame. So as the Federal Reserve moves interest rates around, you're going to see that reprice much more quickly compared to the overall Treasury and CD markets.
Thank you.
Isn't that a macro situation with all banks in general, not only our portfolio though? That banks have a lot of these bonds that have a lower yield in their portfolio, and they're trying to burn them off
Well,
over time, and that's
yeah, it would
the
depend on.
the stress test and so forth.
Yeah, it would depend for the
Dealing
bank.
with that issue.
Yeah, it
because the
depends
market
for.
value's not as,
Yeah.
they're not worth in today's market what they were worth when they purchased them.
Correct. So it depends how the bank has those securities classified. So there's two classifications. They can have them as held till maturity, where that does not have the mark-to-market impact to their capital. If it's held as available for sale, that's where you have the issue. So
Right.
a lot of banks during that low interest rate environment, when they bought the securities, do have them held as held till maturity. So there's not as much stress as you would expect just because of the accounting mechanism that they have to hold them till maturity. But it is a longer, window, because most of those portfolios have durations, and probably closer to 5 to 6 years. So a lot of those book yields were accomplished in that 2% interest rate environment versus the 5 we are in now. So, if they had to mark to market, there would unfortunately be some more pain to the banking sector. But because of the accounting, they don't have to mark to market per se and run it through accumulated capital.
Moving along.
Great. If you'd like, I can go through the performance for each of the individual accounts. Whatever you would prefer us to do at this time.
Well, why don't you just hit the high points of them so
Yeah,
we can,
like the total return
Sure.
on each one would be good. I
Absolutely.
think just for the viewers at home.
Will do. So first up, we have the Merrimack Capital Reserve Fund for the municipal account. This is the $7.1 million account. On a year-to-date basis, the total return is 3.38%. The 1 year is 4.2%, and since inception, it's up 1.03%. That goes back to 2013. Next up, we have the Village District Water account. On the year-to-date basis, total return is 3.78%. The 1 year is 4.5%, and since inception, the portfolio is up 1.28%. Next, we have the Common Trust Funds Principal account. This account has $5.2 million and is a blend of equity, fixed income, cash, and alternatives.
And that alternative is it's JEPI, JAPI, so it's a JP Morgan call right. So it's basically an options, writes options on the S&P 500 to generate income. It has about a 9% yield.
Yep.
Don't want that it's not really an alternative in the sense that it's a marketable security, it's trading, it's not a liquid alt or anything like that. It's an ETF.
On the year-to-date basis, the portfolio is down negative 0.16%. On the 1 year, it is up 3.05%. And since inception, the portfolio is up 7.33%.
And that's an annualized return. So anything longer than a 1 year time period, those are annualized returns, not
Yes.
cumulative.
Define inception just so everybody understands that.
Sure.
You could use that term.
So since inception is
What date is that?
it is January 1st, 2017 for this portfolio. And it's listed in the far right-hand column on all these reports.
I think that's when we swapped from ABCD to the Common Fund with Cambridge Trust. Does that sound right?
Yes.
I think
Yeah.
so.
Yeah. So that's basically the inception date of when we started managing the portfolio.
Because a lot of us still think of it as ABCD.
Okay.
Next up, we have the Common Trust Fund's income portfolio. This portfolio is $3.7 million. On the year-to-date basis, it is up 11 basis points, 0.11%. On the 1 year, it is up 3%. And since inception, which is June 1st, 2017, it is up 7.12% annualized. Next, we have the School District Fund. On the year-to-date basis, this portfolio is up 4.01%. On the 1 year, it is up 4.7%. And since inception, which is January 1st, 2013, the portfolio is up 1.09% annualized. Next, we have scholarships. On the year-to-date, this portfolio is down 78 basis points, 0.78%. On the 1 year, it is up 1.9%. And since inception, which is December 1st, 2012, it is up 7.04% annualized.
So year-to-date, you're using October 31st?
Yes, all of these are October 31st, 2023 numbers.
Things have gone crazy in the last 2 weeks.
The numbers would look much better if we ran it as of yesterday, yes.
Yeah.
Yes. And then last, we have the Barry Quimby Memorial Common Fund. This portfolio is down 3.02% on the year-to-date basis, down 56 basis points, 0.56% on the 1 year, and down 2.45% since inception. And inception was June 1st, 2021.
So is that because it's heavily weighted with fixed income, and when you put the money into fixed income, in the inception, you put it in fixed income with lower yields, and now they're
Yeah, so here we're
gone
using,
down, or what?
yeah, we're using mostly a mutual fund for the bond sleeve. So it's a fidelity fund, but exactly what you're saying. It was, the longer term performance, because we purchased it when rates were lower and rates have risen.
Yes.
And
And that's the final fund that we manage.
Any questions over here, Adam? Liz?
Nothing from me, thank you.
I don't have any particular additional questions on this. I'd just like to, maybe I'm jumping ahead, but if you could tell us anything about the pending acquisition by Eastern and how that's going to work. Is it, they've proposed it's going to be transparent. I've been through a few acquisitions of my own, and they don't typically end up being transparent, or seamless, I think is a better word.
yes.
So if you could just kind of comment on that.
Yeah, happy to. Most people know Eastern Bank has gone into a merger agreement with Cambridge Trust. You almost have to look at it as a reverse merger. So basically, Eastern Bank wanted more non-interest income after they sold their insurance business, and to grow out their wealth management platform. So they mostly acquired Cambridge Trust for the wealth management platform. So Cambridge Trust will assume the management responsibility of the combined entities of the wealth management platform. So our head of wealth management, Jeff Smith, will become the head of wealth management of the combined entities. My boss, Dave Lynch, the chief investment officer, who you've met in the past, will be the chief investment officer of the combined entities. All of Cambridge Trust employees within wealth management will have their same roles within the combined organization. So what does that mean for Town of Merrimack? Lindsay, myself, and Lisa will remain the people managing your portfolio. Will remain your day-to-day contacts. So there's no change there. It increases the AUM in wealth management. Cambridge Trust is about 4.6 billion. Eastern's about 3. So the combined entities will be about a $7.6 billion in AUM on the wealth side. Combined bank will be about over, I think it was $26 billion. So the fourth largest bank in Massachusetts. The model, procedures and the structure that we've created within the wealth management division of Cambridge Trust will be parlayed into Eastern Bank when that merger comes through. So I think you never say it'll be seamless, but from what we've been told and what we see happening, it should be relatively seamless, especially within the wealth management side, as we will have the control of the combined entities.
Will you still be in, are you guys in Cambridge?
We've been in Boston for, how long have you been with us?
8 years.
Yeah, so we've been there for well over 8 years in Boston. We will be moving more than likely from our current 75 State Street to 125 High. So we'll be staying within Boston. We're hybrid. Most employees are 3 days a week in an office, and that will continue. I think that Eastern has a little bit more of a flexier type work from home policy. Cambridge Trust a little more rigid as far as sticking to the three days a week in the office, but we will maintain a Boston presence, as well as I think there's several. And Lisa can answer this. There'll be some several branches of Eastern Bank that will remain open, as well as Cambridge Trust in the New Hampshire market. I think you'll be gaining more banking exposure within New Hampshire.
All of the New Hampshire offices, are staying in place. So the Manchester office that you helped christen a little while ago will remain. The Portsmouth office is also, and then I think we're going to expand again our Concord office. So I also want to just mention our systems are also, I think they're the existing system that we're using now is going to be the system going forward. So even that should be transparent to you all. So
As far as banking in New Hampshire is concerned, do you have a backroom kibitz about what's going on with Bank of New Hampshire? Are they changing direction? I guess they are if they're getting out of the retail business.
I'm not familiar with what's going on with Bank of New Hampshire.
I
apologize.
actually talked to Mike yesterday about that.
Bank of New Hampshire has recently announced they're not doing retail mortgages anymore and retail
Okay.
consumer loans.
Oh, okay.
That type of
Supposedly
stuff.
they don't make money at it. It's kind of a pass-through business,
Okay.
and they only make 17 basis points or something like that on a mortgage. I don't know that much about it, but they laid off 19 people, or they're laying off 19 people and getting out of
Okay.
the residential business, keeping the commercial and focusing on commercial and wealth management.
Okay.
Wealth management seems to be a popular area in the banking business.
It is, yeah, for fee revenue versus interest income. Inverted yield curve is not a friend to the banking sector right now. If you have to pay your depositors more than what you can, pay, you're paying your depositors more than what you can lend. It's not a good environment.
Right.
Yeah.
Okay, anything else?
I don't have anything else. I don't know
I
if
have
Lisa-
nothing else.
Okay, well, I got a couple of things for you then. We have here, let me thumb through.
Well, actually, I apologize. I did want to ask if there were any planned spendings from any of the capital reserve portfolios. We just typically like to
coming.
see an update. Perfect.
It's coming. So you can have a copy of this. Actually, I think we sent this out earlier by email from the, this is mostly MVD. So I think you've seen it, but you have copies.
More copies?
You need one?
I have one of them.
Okay, thank you.
Need any more? Is that great?
Yeah. So that's 66, oh, I didn't keep one for myself. Can I have one back?
Here you go.
Thank you. The 66,000 we've already dispersed that the MVD was looking for. But this gives some of their other future deposits that'll happen next March or April when they have their annual meeting. And so that gives a picture of that. The school district has said they don't have any planned capital reserve fund expenditures in the next 6 to 10 months. So that's, they don't rely on capital reserve funds very much, which is why they only have $1 million there.
Mhm.
And the town, do you have a number for us, Adam?
I would have to get the meeting minutes from prior meetings, but I know last night they authorized about $250,000 for a Caterpillar wheel loader for the compost facility, and then another $7,500 for a welder.
All right, we're still gonna be about $1.5 million to 1.8, maybe 1.8 in June.
You mean this coming
The,
June?
the town accumulates all of their capital reserve funds, expenditures. They pay them out of their working capital. And then we reimburse the total amount for the year in June, which is usually between $1.5 million and $2 million. You don't have a
Okay.
number for us?
I don't have a number right now, but I can get one for you.
Okay. Yeah, I think, email it so we can email it to them, but it's gonna be in that $1.8 million range, I'm pretty sure.
1.8 million. Okay.
Maybe 2 if they're gonna buy that new loader. So that's really the anticipated expenditures. The other expenditures that are coming out of scholarships and the like are pretty routine. We spend about $12,000 every year, and usually in January. So I think that's about it. And then, of course, the perpetual care funds we just paid a month ago. So we're good there for a year. Does that cover what you were looking for?
It does. Thank you.
Okay. Anybody else have anything else on expenditures? Okay, give me a second to move along to the next item. All right, next item on the agenda is scholarship authorizations. And what we do is annually, this time of year, authorize paying the scholarships as the requests come in, because they come in December and January when we're not meeting. So if you want to just authorize me to pay those things, then
I would motion we
Mhm.
authorize to pay scholarships that come due annually.
I'll second that.
okay, moved and seconded. All in favor signify by saying aye.
Aye.
Aye. So it carries 300.
I think
Liquidity needs we
you
talked about.
covered.
I'm sorry?
I think you covered that, right?
Yep. Lego fund, I still have not heard from the school. We did establish a separate fund for Lego. So if that comes in, should I pay it?
Yes.
Okay. We'll lump that
A
in.
motion for that to pay,
Is that part of the?
Yeah, that's the same part of the thing.
providing that Lego
Okay, we'll do it as
comes in, pay it.
300.
Yeah.
Yep.
Thank you. I have here a check for $10,000 to go to the Bear Christensen Fund. We don't need to do anything on that. There was a public hearing last night, and the town council accepted that money on behalf of the town, so we just needed to deposit it, but you needed to know it's there. $7,000 going into principal and $3,000 going into the income side.
Very generous.
And future meetings, January 19th, February 16th. Anybody know if those are good dates?
19th, I don't think works for me unless you want it to be via telephone. The following week would probably work for me, but then you're getting close to February's meeting, but
Yeah. How about January 12th?
no. for me.
I can be free either of those weeks. Once we move into February, February 2nd and February 9th, I'm not sure which dates yet, we'll be likely out of town.
All right, well, let's leave the February 16th. Let's leave it as the 19th. If we have to do it by phone, we'll do it by phone. You're around for that date, right, Liz?
I am.
Okay.
Do we have an alternate?
We do not yet. If you know of somebody who's suitable, then that would be something to bring back to us.
Okay.
And anything else that we should be discussing that's not on the agenda? Adam, you have anything for us?
No.
Okay, Liz,
Nothing.
Bill?
I'm good, thank you.
There being no further business, we are adjourned. It is 9:50.